Last Friday, I did an impromptu live session for free on my public Discord. You can use the link in the description to join and participate in the next ones. I explained keys about my strategy, volume, Wyckoff, and specifically my 4 questions trending system. If you haven't watched that video, I recommend you to go over it before watching this one. The link is in the description. And we analyzed USD live, calling pretty much every move that happened on Friday. I'm doing this to actually help you mastering my strategy and maybe combine it with yours. It takes time, and I would really appreciate if you liked and comment. Without further ado, let's begin. Since we have recently come from making some daily moves, we're going to explain what just happened. So recently price created equal lows between this low here and this low to the right. The intention of these equal lows is to generate a bullish expectation so people start buying. And by people, I mean less informed traders or those who are not going to be trading in favor of the small money. So these less informed traders are going to be buying from here because they see this as a support level. Now, what a coincidence. As soon as this equal low was created right here, we see that price is creating now a bullish trend line. This adds to the intention of creating a bullish sentiment. So people, again, less informed traders, start buying from. So when everyone is buying and price keeps breaking and making higher highs, as you can see here, what is happening underneath the chart behind the candles? What is happening is that below these equal lows and below this trend line, there are going to be sell stops getting accumulated. Why sell stops? Well, if you imagine everyone buying from here, all of the stop losses from the buys are going to be placed below this level, and the stop loss of a long is a short. That's why there are sell stops. So with my money, after having accumulated, after having engineered a bullish sentiment, what they will do is do the spring or shakeout. In Wyckoff is a wave that grabs the most liquidity and then reverse and initiates an uptrend. So you can see that happen recently when price went lower, triggering all the sell stops that were sitting below these lows. And after those sell stops were triggered, smart money accumulated those as longs down here. So since that happened, and now we see a bullish reaction and breaking the structure, because even though this is only a week, I consider it to be a break of market structure right there. Now we can anticipate a potential bigger move with a higher probability. Nothing is 100% in Forex, or everything is in terms of probabilities. So now the most probable move for USD will be to initiate an uptrend. On the higher time frame, we have this lower time frame structure. I always use the path tool to mark the structure. It's very useful because it graphically helps you identify the structure when you are looking at the charts. You can see we have some kind of accumulation on the lower time frame here, and then we have a break of market structure. So higher high, higher low. Then we have a higher high, higher low right here, and then higher high. We recently had a break of market structure for this red trend that now is bearish, okay? In order for price to break the structure, it needed to create a lower time frame downtrend that we can see like this: lower low, lower high, and then we have a lower low here, lower high, then lower low, lower high, lower low, lower high, and lower low. This is going to be from a lower degree of structure. So the higher time frame or the higher degree of structure is the red one, and the orange is the lower degree. Now, in the red one, we are inside of this range from this low to this high, because which was the most recent break of market structure for the red one to a downside. Since that's the most recent break of market structure, then we identify the last high and the last low as our range. If you know about premium discount and equilibrium levels, just to have an idea of where my money is looking for longs and shorts, we are currently sitting at a discount level of this range. This is equilibrium and this is premium, right? So let's write down the story for these structures using the 4 question systems. For those who are not familiarized with the 4 questions, I will very quickly write them here. So now we are going to answer these questions for each one of these 2 different degrees of structure that we found here on this chart. So for the red one, the first question is the trend bullish or bearish? The most recent break of market structure was to the downside, so we say that it's bearish. Now, price is currently here. That means that we are at a discount level. We could say that price is coming from premium and now at a discount level, but that would be wrong, because we just created a new range, a new lower low. In order to say that we are coming from premium and we are at discount is if price did something like this. In this case, price would be at discount coming from premium. But this is not the case again because we just made a lower low, creating a new range. So we can only say that it's at discount. All of this range is discount. Here is equilibrium and all of this up range is premium. So the red one is bearish at discount. What is the target for this red downtrend that we see here? Well, if we zoom out a little bit more, you will see that this red uptrend and now downtrend is trapped inside of a bigger structure that we can see here. We had an accumulation range, price broke the accumulation, making a higher high. Now it created a potential higher low, and we are trapped in this range from this low to this high. This higher time frame structure, okay, is bullish. So that means that when price is at a discount level, which is anything inside of the main accumulation, price could continue going higher. And for that reason, we are going to say that the purpose of this downtrend, the red one here, is to mitigate a bullish point of interest, which in this case is going to be all of this range, which, by the way, if you look at my YouTube videos, I anticipated all of this move down. And from here, I told you guys that price was likely going to push back up. So we will see about that in a few days, in the coming weeks. But anyways, the purpose of this down break or market structure on the red structure is to hit this level in order to mitigate it before pushing higher. We are just going to say the target was to mitigate the higher time frame bullish POI, and it was met. Why do I say that the target was met? Because we are hitting a POI, and on the lower time frame we just had an accumulation that was broken on the lower time frame. So the target was met. Now price is likely going to start a move higher. So the expectation for the red trend, what is the expectation for the next move, is to reverse. So now that you have your higher time frame analysis with the red, don't forget to use the path tool to mark what is your expectation on the chart. So I use it using I use the path tool and I use dashed line, so I know this is the expectation for the analysis, the most probable expectation based on the analysis. Now for the orange one, I forgot to mark that we had just a higher high here. Price is bullish or bearish? Well, the most recent break of market structure happened to the upside. That means that price is bullish. Where is price now and where is it coming from? We just created a new higher high. This is the range from the last low to the last high. This is premium, this is equilibrium, and this is discount. Price is currently at premium. Now, what is the target for this trend, for this uptrend on the orange? Remember that our expectation for the higher time frame is to reverse the red downtrend, basically to break this high. So the target for this uptrend that we see on the lower time frame, in this case the orange, could be to break this high. So basically I'm saying that this is very likely going to happen, or could be to mitigate all of this range that was left unmitigated, perhaps doing something like this, then breaking lower to accumulate more orders and then pushing higher. We don't know. But the next logical target, according to our higher time frame bias, is to hit this level, which is an unmitigated level, and it's in the same direction that our higher time frame expectation, which is going higher. Okay. So for now, the target, we are going to set a number here. I'm going to place an horizontal right here where we have this imbalance and this all of this distribution was broken, never tested, and this point here 1.19753 is our target for now. Why is important to identify the target? Because when price comes back to a discount level, we know that if our analysis is correct and the target is higher, this low should hold price. When price makes a higher high, when it comes back to the new higher low, it should hold until we hit the target. Okay. Do we mark every impulse wave with premium and discount? Yes. Only the current ones. Okay. I don't need to mark this one because this is past price action. Price is right here. So this range is outdated. The most recent break of market structure is the one that gives you the range. In this case, for the orange one, the most recent break of market structure happened here. So this is the range from this high to this low. For the red one, the most recent break of market structure occurred here. So this is the range from this low to this high. Expectation for the orange is to continue going higher from a bullish point of interest. Okay, so in other words, the expectation for the orange is to do something like this. There we go. Now, this is the higher time frame bias according to our analysis. What do we do with it? Let's assume for a moment that we are intraday or swing traders. We will mark the point of interest. In this case, all of this move down represents the point of interest, because in this move, smart money sold to capture and trigger the sell stops, and then they absorb those sell stops as longs here, and then they push higher. So in this range is where they have shorts and longs opened and where the mitigation should happen. So anywhere inside of this range, we could look for long. If we didn't want to wait for a confirmation, basically a lower time frame break or market structure, if we were swing traders, we could already take a trade like this, for example, aiming at least for the first target right here and the second target higher up here. But I am not a swing trader, I'm a scalper, and I did this high time frame analysis just as a demonstration of what can be done with the 4-question system. Now, let's jump straight into the lower time frames, which is my home. So guys, the break or market structure doesn't have to be with body or with the wick. I don't care about that. As long as price makes 1 pip higher or 1 pipette even higher than the previous lower high, for example. So let's say a price is in a downtrend and we have 1 pipette higher here, that's already a break or market structure. Whether the low that produced that break or market structure will hold or not is based on Wyckoff mostly and volume. Okay, so if there was a Wyckoff accumulation and this was a spring, then this low is very likely going to hold. But if this is a normal market structure and we have a break, for example, without any Wyckoff manipulation, then the probabilities of this low holding are decreasing. And even worse, if we see something like this, a break higher and then price starts going lower, this low has even lower probabilities of holding due to the fact that they engineer equal lows, which is building a bullish sentiment where others are placing stop losses here. So it really depends on what is the structure that led to the break or market structure to identify if the low is likely going to hold or not. In this specific scenario, as we mentioned at the beginning of this session, there was a lot of bullish sentiment being created with these equal lows here and all of this trend line. So when price broke higher here, you can see it broke with body and all, but even though that happened, price later, boom, pushed lower. It's not only a combination of how this structure is getting broken from where, in this case, obviously it was very weak break because of these equal lows, but also in terms of structure. The structure was still bearish here. So this break or market structure bullish is only from a lower time frame structure, but the higher time frame was still bearish and price was likely going to continue pushing lower. And if you add that to the confidence that we are coming from equal lows, even worse. It's easier. From here, you can take a very easy trade based on lower time frame confirmation to capture all of this move, taking out these lows. So remember, we don't trade patterns. I don't care if it closes with a body, with a wick, I don't care. What matters is if there was a process of accumulation backing up that break or market structure or not. And that process is happening aligned with a higher time frame structure or not. Those are the questions you should be asking. Now let's jump into the 15-second chart right away. Boom, 15 seconds. From the daily to the 15-second. Beautiful. Now in the 15-second, what I do is I grab the path tool again. I start marking up my structures. I can already see 2 or 3 different degrees of structure. The first one is this one right here. High break, higher high, higher low. Okay, we have multiple degrees of structure, so I will use different colors. Boom, boom, higher high, higher low, higher high. That's one structure. Now on the lower time frame, we just had a downtrend here, low, low, lower, high, low, low, high, lower, and then we have an uptrend and now a downtrend again. So the white created a break or market structure to the downside, and then we have a lower time frame uptrend and now downtrend, right here, we have a lower low, the first lower low. So the white is bearish, the red is bearish. Let's jump into the 5-minute chart. We have another downtrend here on the 5-minute chart. Lower low, lower high, 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 lower low, and now higher high. This is going to be the orange one. So let's start describing this structure with the 4 question systems. First, orange. Is price bullish or bearish? We just had the most recent break of market structure was to the upside, so this is bullish. Currently, price is right here. We made a higher high. Okay, price is at premium. You can see that we had a lower time frame structure, the white one, that was broken. So if this is the range for the orange, from this low to this high, price is at premium coming from equilibrium. What is the target for this bullish 5-minute structure? Well, in order to identify a target, we need to always zoom out and understand what is happening on the higher time frame. We can see that we are stuck in this range from this high to this low on a higher time frame. All of this is internal liquidity. So it is possible that the target for this potential up wave that we are going to see on the 5 minutes is to grab some more liquidity and here feel an imbalance. So for now, we are going to identify this high, which is where the imbalance is, as our most likely target, 1.143. Now, what is the expectation? If this is a target for this 5-minute break of market structure and the target wasn't met, the expectation is for price to continue higher. Let's jump into the white, but first let's mark the expectation for the orange one. The main point of interest for the orange is all of this range right here. This is the main spring here, or setting climax to automatic rally that breaks the structure. Setting climax, automatic rally, breaking the structure, then we have a test and a reaccumulation and then continuation higher. So this and this are my main point of interest. This is the accumulation, and this is the backup or last point of support that mitigates the accumulation. So all of this is our point of interest. So what we are saying for the orange is that price is likely going to move higher like this, the most probable. Now, in 10 minutes, I have to close the live session, guys, by the way. We have white. White is bearish, currently at premium. The target for this white downtrend was to hit this bullish POI, and it was met. Therefore, the expectation for this white downtrend is to reverse or produce another leg down to a discount level from the orange before reversing. So essentially, we are saying that price will either push higher like this or produce another leg down and then push higher. Both scenarios are possible. So now we can mark this first scenario and then we can mark the other one just in case it happens. So we have it on our chart. The purpose of marking these expectations is for you to not lose sight of your own analysis when you are very low on a lower time frame, okay? Because it's very easy to get confused. Okay, now it's turn for the red structure. We have an uptrend on the lower time frame. We have a break of market structure, and now we are retracing back into this bearish point of interest. Okay, so this is important. You can see that price is going back to test this distribution from the origin of this leg up. So to mitigate this move, let's say that they want to go a little bit lower. To mitigate this move, they need to grab internal liquidity, which are these highs here, and then go lower, or grab external liquidity all this high and then go lower. For the case of a bearish situation, like going lower and then going higher. For the case of a bullish situation, price from here should be able to continue pushing higher. Now, depending on how much volume there is here, we can identify if price is likely going to go after this high or not. Okay, so let's add volume and let's see what is happening. Okay, we can see that there is a lot of efforts on this range when price was quote unquote fighting between this distribution and this recently created accumulation. And who won? Buyers, because price pushing higher. Now we see high volume, price trying to get higher. So we can say that price is now very likely going to go after its high because of the amount of volume that we are seeing. So how can we take a trade about this, based on this? Well, if we go to a 5-second chart, there was recently an accumulation, a break of market structure, a test, and then continuation. So we have another break of market structure. Essentially, we are on this uptrend now on the lowest time frame. We have a higher high, higher low, higher high. This is our new point of interest right here. You can see our price is breaking higher on this last leg up, but volume is decreasing. So instead of taking a buy limit from here, because volume is decreasing, I will wait for another confirmation. If there is another confirmation here to take a long and volume supports that idea, then I take a long. Otherwise, without confirmation, price could continue going lower. That's why we are waiting for a second confirmation. Different situation would have been if price broke higher and volume increased like that, then in that case I will have taken a long right there. Okay, so now I require another confirmation, otherwise price might grab some liquidity, perhaps here or even here, before going higher again. We don't know. So you either wait for a confirmation here, wait for a confirmation on this POI, or wait for a confirmation on this POI. If you don't have no confirmation, then no trade. And the confirmation is simply a downtrend that gets broken and volume supports that break of market structure. You see how important volume is, and this is when you can identify with a higher probability if something is a break of market structure or only a stop hunt, or well, stop hunts is a way of saying it. In this case, this break lacked of volume, so it was very likely going to be a liquidity grab instead of a break of market structures. My money wasn't supporting this move up, so you either have a reversal or a deep retracement and then continuation. In any case, you wait for a second confirmation. No point on looking for long here, you see? And if you don't have any confirmation, then that's fine. You don't take any trade. At least you didn't lose money. If you had a confirmation, you take a trade, and obviously you make money. Based on the speed and the volume that is trying to go lower, the most probable move now is that price will try to take out this high because they have induced buyers by pushing price higher than this high, breaking higher. These buyers are placing the stop loss below this level. So price is likely now going to grab that liquidity and then perhaps going higher, okay? But in any case, this is now a bearish break of market structure. So we should be looking for shorts at least until we hit this low. If there is any opportunity to get into a short, we can take it. Volume spread for BSA is the name of this indicator, but it's exactly the same as normal volume. Before I go, because I need to leave now, we are hitting these levels right here because setting climax automatic rally, second day test, second day test on phase V, fail up transaction spring. So all of this is an accumulation rather. So if there is any kind of confirmation from here to take a long, I will take a long following our bias. If there is no confirmation, then guess what? Price is likely going to continue going lower. And I'm happy that I didn't take any trade because I respect the rules waiting for a confirmation. Now, what is the confirmation? We have a downtrend, lower low, lower high, lower low, lower high, lower low, lower high, lower low. This is the lower time frame trend. So first of all, we need to see this getting broken. If this gets broken and volume supports the idea, we can look for a low. You set an alarm here, you forget about the charts, and you come back to the chart only if the alarm turns on, in which case you look for that trade. You don't need to stay in the charts after you do your analysis. The analysis is this one. The indicator. You go to indicators, volume spread for BSA is the only one that appears. You click there, it will look like this. The only thing you need to do is deselect everything that says plot. Boom, 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 boom. Boom, boom, boom. You only leave title in. And it will look like that, but it's exactly the same as normal volume. The only thing that changes is the color of the bars, depending on the most relative, the closest bars. If the closest bars are smaller, then this one is going to change to yellow, and if it is way bigger, it's going to be red. So red, yellow, green, and blue. That's the order. Here we have a very big bar compared to the closest ones, and it's red. Now you can see here, oops. Price is building equal lows, so we are currently ranging for any bullish scenario. If price breaks from here, I wouldn't like to take that trade because we are coming from equal lows, so I would rather wait for this to be taken out before pushing higher. So now I would change my alarm to these lows. This is the condition to look for a long, waiting for these lows to be taken as liquidity.